The S&P 500 is up over 14% for the year to date, which means prices are on their way back to all-time highs. With the S&P 500 getting back to its highest price, this is a tough time for investors because just like you, we're all wondering, when is it going to drop? Economic experts are once again ringing the alarm bells over an imminent downturn. A US recession is coming, they say, in the second half of 2023. That time frame begins less than 3 weeks from now. So with all that information, it seems like buying into the S&P 500 may not be your best bet right now. And instead, waiting until it does drop might be your best move. Kevin had a very solid question that I'm sure you're struggling with as well. And he asks, I throw $500 into VU every 2 weeks, but now VU is too high. I feel like it's gonna fall eventually and feel hesitant to buy in so high. So I've been putting the money in my brokerage account uninvested. Should I just buy high or wait it out? Great question, Kevin. Let's discuss. I'm Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. And if you're like Kevin and you have these types of questions, you should definitely consider joining my Patreon group, where we have live Zoom discussions to get all your questions answered by not only me, but a group of 75 to 80 other investors who've been in your shoes. You'll also get unlimited access to me to DM me your thoughts, and it'll only cost $20 per month. All right, so just so we're on the same page, this topic and this type of conversation goes for all types of investments and ETFs, but for today, we're going to be talking about the S&P 500, which is a pretty accurate indication for the entire US stock market since it's the top 500 companies by market cap in the United States. A couple ETFs that track the S&P 500 would be VOO, VOO, SPY, SPY, IVV, and SPLG. Then there's a couple mutual or index funds that track the S&P 500 as well, like SWPPX from Charles Schwab, FXAIX from Fidelity, and VFIAX from Vanguard. So when we say invest in the S&P 500, you can pick pretty much any of those. Now, since I am a university professor in my day job, I'm going to ask you a question the same way that I would ask my students a question. Which scenario is best to buy in at? The S&P 500 is up at its highest, or the S&P 500 is low and at its lowest and can only go up? Now obviously you know the answer, and that is the latter. There's only one problem though. No one knows when we're at the bottom. And even more so, no one knows when we're at the top. Every analyst and economist was freaking everybody out at the end of 2022, telling them that the recession is coming in 2023. They said to sell your shares because we're at the top of the market and the market will fall in 2023. So then you can buy in cheaper. So many people did sell their shares. If you had $100,000 sitting in the S&P 500 in December of 2022, but decided to sell it because you were scared that it was going to drop in 2023, you would have missed out on the 14+ gain so far this year in 2023. You would have missed out and essentially lost $14,000 this year so far. Looking at this historical chart, there are times when it's up a bunch and times when there's a drastic drop. But overall, through history, it keeps going up. If you look in 10-year increments, it definitely rises upward, and for 20-year periods, it's always up. Now, some may point to this idea of the lost decade. I've been hearing this a lot lately. So there have been periods where one may invest some money and then have zero or negative overall average return in 5 to 10 years. Particularly 1999 to 2009 was pretty bad. And just a little side note, anytime people like to pick apart the S&P 500, they really like to pick just the worst time possible. Obviously, 2009 was a huge financial crisis, and the S&P 500 did drop a bunch right there. But spoiler alert, as you'll see later, we recovered. Anyway, that lost decade of those 10 years was pretty bad. But that's the worst case scenario, right? So let's just say in this worst case scenario, you were diligent and you just kept dollar cost averaging and putting about $5,000 per year away for that whole decade. That's $50,000 in the S&P 500 at an average rate at that time of about $1,100. $50,000 divided by 1,100 gives you about 45.45 shares. Today, the S&P 500 is at $4,375. So that times the 45.45 equals $198,843. Had you invested during that lost decade and not made any money, Yeah, that would have been bad for that period. But had you not put any more money in other than that, literally never invested another dollar into the S&P 500 after that point, today, just 14 years later, your money would have quadrupled. Would have went from that 50,000 to almost 200,000. And that's the worst case scenario with the S&P 500. So what am I doing with this information? I'm continuing to dollar cost average like usual. I'm shutting out the noise, and there is a lot of noise about the recession and about this possible market dip. And even though it does make sense, and I even partly do believe that the market may dip by the end of this year, that still is not going to derail me from dollar cost averaging now, because I'm not investing for this year or next year or even the next 10 years. For anybody watching this that's investing for 10 years or later, this price range should have no bearing on what it is that you're doing or how you're investing right now. I'm investing for financial freedom in the future, and I believe for a fact that the S&P 500 is going to be way higher in 10 to 20 years than it is today. I'm invested incredibly heavy into the S&P 500 along with my two other favorite ETFs that you can learn about more in this video, where I go over my new 3 ETF portfolio that's absolutely crushing everything else out there. It's super simple with crazy returns. Watch this video now and let me know what you think.